Good.
Thanks, Denyse. Hey, good morning, everyone. My name is Brendan Lund, and I'm a shareholder and chair of the Hopkins Carley Corporate and Taxation Department. We've been really excited to participate as a key partner with the Silicon Valley Forum Startup and Venture Capital Club over almost the past year. And I just wanted to take a minute to explain to you guys or share with you information about our firm and our department in case you're not familiar with us. So Hopkins & Carley is a full service law firm with offices in San Jose and Palo Alto. We have over 70 attorneys geared towards working with startups, investors, and established middle market businesses through all phases of the business life cycle. We have a lot of expertise in various subspecialties, including corporate finance, M&A, IP, tax, which you'll hear about today, corporate governance, branding, trademark. We also have, outside of our department, expertise in real estate, employment, business litigation, and privacy and data security. Basically, these are all the things that any startup venture is going to need in terms of legal services. We're also unique in our Silicon Valley, the legal community, in that we have a very sophisticated family wealth group that is probably one of the best in the state of California, that can help founders put an estate plan in place at the early stage when the valuation of their company is low. The feedback we get is that our clients enjoy working with us, and we enjoy servicing our clients. One of the things that Hopkins & Carley focus on is understanding the client's businesses and their operations, the technology behind it, so we can provide a really practical and efficient advice. We are comprised primarily of former big law attorneys, and our clients work directly with a partner level person so that you're getting some seasoned experience advice. So that's our firm. I look forward to presenting after Sepi on the latter half of this hour. But I wanted to take a moment and introduce to you my partner, Sepi Ghiasvand. She's a tax attorney and a business attorney, and she's going to talk about a number of important things here this first half hour. So Sepi, back to you.
Hi, everyone. Good morning. Today, we're going to touch on quite a few topics. I will be talking at a very high level regarding the tax impact of the different kinds of entities that you can form in running your business. And I just realized I haven't shared my screen yet. Sorry. There we go. Okay. Can you see my screen?
Yep.
Great. Okay, so first of all, we're going to talk about the choice of entity. This is a topic that comes up with some frequency. Our clients always want to know. The first question in our discussions is what entity should I choose to operate my business? Or sometimes they want to know whether they have the right entity, if they should be considering converting their entity into another type of entity. I think what plays into this quite a bit is the kind of tax ramifications at different stages of formation, operation, distribution, liquidation. So today we'll touch on all these topics and at a high level. These are fairly complex issues that we could dig into deeply, but I will try to cover a lot of different issues fairly quickly here. And we'll discuss LLCs, partnerships, and I'll be using those terms somewhat interchangeably because an LLC is in fact a partnership for tax purposes. A C corporation, S corporation, and here we go. So we'll talk about the basics of formation. LLCs and partnerships are formed by filing articles or a certificate with California Secretary of State. You also want to execute an operating agreement or a partnership agreement. And there are no limitations on who can own an interest in a partnership or a limited liability company. The agreements generally contain economic provisions, tax provisions, management provisions, transfer provisions. All these provisions are in a single document. And you can have different classes of interest in an LLC or a partnership. In a C corporation, you file articles of incorporation as well. You adopt bylaws and stock plans. You execute stock purchase agreements, and sometimes you'll have a separate shareholder agreement amongst the shareholders. There's no restriction also with a C corporation on who can own shares. And you can also have multiple classes of stock. With an S corporation, basically the formation is exactly the same as a C corporation. An S corporation doesn't exist for state law purposes. It's a tax concept. And basically you make an S election within 75 days of forming your entity. An S corporation has lots of restrictions, however. The owners can't be entities, trusts, or foreign persons. And you can only have 100 shareholders total in a single class of stock. And that's probably why you don't use an S corporation, generally speaking, for tech companies who are looking to raise funding, because obviously you don't want all these restrictions on who can own shares in your company. You can't really raise funds with a restriction on who can be a shareholder, whether they're a foreign person or a US person for tax purposes, an entity or a trust, etc. And I do want to point out that this is something that people generally aren't familiar with, but there's some tax elections that you can make to get, to have an entity treated basically differently for tax purposes. For example, an LLC or partnership can be treated as a C corporation, which is rarely done because, as you'll see throughout this presentation, C corporations aren't very tax friendly. But you can also make a tax election to treat your LLC or a partnership as an S corporation. So throughout this slide deck, or through in talking with your CPAs, you have a change of heart. It may be possible for you, depending on what kind of entity you have, to change the tax treatment of that entity. And with respect to S corporations, if you fail to meet any of these requirements, you basically revert back to a C corporation. It's not that you'll dissolve or anything horrible happens. You just have a different tax treatment moving forward. The first stage of formation, obviously we discussed, and then there's capitalization, which is the partnership or the LLC offers their interest in exchange for initial capital contribution from the potential partners or members. And there's no gain recognized at that point when you make that initial capital contribution. If you formed an entity, you're already familiar with that and that concept to some degree. Obviously, people would be a lot more hesitant to form entities if they were going to be taxed right out of the gate. But a gain is not generally recognized and contributing capital to an LLC or partnership, except where maybe you're contributing some sort of encumbered property that relieves you of liability. You may have a taxable event when you transfer that liability to the partnership. Also, if you're exchanging services for a partnership interest or a limited liability company units, you may also have a taxable event. Same with the C corporation. You don't have a taxable event initially when you contribute property or cash, but you could recognize gain if your shareholder is relieved of some sort of liability when they initially contribute capital to the corporation. Also, with shareholders, you have to have control of the company. You have to own at least 80% of the voting shares in that initial formation stage in order for the initial capital contribution to be tax-free. Again, if you provide services in exchange for stock, you could potentially have a taxable event. And I think that's when that kind of sneaks up on founders on occasion. S corporations, no difference really there. So there's not much of a difference from a tax standpoint when you initially form your company. Here's where it gets a little bit more interesting. Partnerships and LLCs are only taxed at the partner level. That's a big advantage when you have a flow through entity. You may be already familiar with this concept. The entity basically distributes K1s and passes the income and deductions, et cetera, to the partners. There's no tax at the entity level. Another benefit of having a partnership or LLC is the qualified business income deduction of 20%, which was passed, in the past few years. I wanted to say recently, but I guess that was quite a few years ago now. The qualified business income deduction is applied at the partner level. So each partner has to qualify, and they can be individuals, trusts, or estates. And you have to have income under 163,000 approximately, or 326,000 for joint filers. With a C corporation, you have a 21% income tax at the corporate level, and you could also get taxed when you receive a dividend as a shareholder, up to about 20%. Sometimes corporations will just not distribute dividends at all. By basically pushing out the income, bonusing out to their officers and shareholders and paying expenses. And there's some risk in that because the IRS can come back and say, well, these payments that you made to these shareholders, these bonuses are excessive and they really should be dividends because it's not a reasonable market payment to the shareholders who are acting as employees basically for a C corporation. If you hold on to the dividends and you don't make distributions, you could potentially be subject to this accumulated earnings tax of 20% above 250,000. S corporations, pretty much same as partnerships. So you're subject to a corporate level tax, however, in an S corporation, if you were formerly a C corporation and you converted to an S, and after its initial year and you have passive income, you could be subject to a 21% passive income tax. If formerly you were a C corporation and you make an S election, because remember, a C corporation basically is what you start with, and then you make the S election. And so depending on the timing, if you make it after your first year, then you could be subject to some of these C corp taxes. So if you have a C corporation after formation, you could be subject to a 21% built-in gains tax. If you basically distribute your assets, appreciated assets, or dispose of them within 5 years after you're an S corporation. So one interesting development recently for those who live in California is that, there's a bill that just passed that is effective in 2021, when you can have a workaround to the SALT limitation deductions, that the $10,000 federal limit. And it's interesting because it's one of the few times that you can actually, and I've been saying, well, you don't pay tax at the entity level, but here it allows the partnerships, LLCs, and S corporations to pay tax at the entity level in California, not for federal purposes. And it's based on the individual's share of the income they receive. And you basically get a credit. Once the entity pays it, you get a credit. And that amount is obviously deducted from your federal income tax. However, you have to be a partnership, LLC, or S corporation. You cannot be a C corporation. And the individual owners or the owners of the LLC, partnership, or S corp have to be individuals, fiduciaries, trusts, estates, etc. They can't be another partnership. They don't want layered partnerships on this tax benefit. It's a 9.3% tax on the total. So everyone who, you can elect to be a part of it if you're in the entity, and everybody their share is then taxed at a 9.3% tax. And it's for California residents. It includes all of their distributive share of income. And for non-residents, they can also participate by including all of their distributive share of California source income. And it's interesting, like I said, because not all the owners have to agree, but some can elect to do this. And it's basically a nice little tax break after that limitation was put on the states a few years back in 17 and 18. Couple other California considerations. Clients are always asking, well, what's the downside of forming an entity in California? Gross receipts tax. You have a graduating tax in California, but really it maxes out at about 11,790. So it's really not that high. I don't think it's ever dissuaded anyone from doing business or forming an entity in California or having an LLC. S corporations also have a 1.5% S corporation tax. So that was a lot of information, but basically what you want to take away, I think, from this is, and what you'll continue to see, is that, pass-through entities have an advantage from a tax standpoint. You have a single level tax. You have the qualified business income deduction, which may not be something that you can take advantage of, but it's there, and some folks may be able to take advantage of it. It's a nice little perk. And then you also get that new law in California that helps you take a chunk out of that income from California out of your federal income taxes. So all these different provisions, I think, make a pass-through look really attractive to a starting business. Another aspect of partnerships and LLCs is that you can have flexibility. Partnerships can provide for special allocations for specific items of income or expense amongst the partners. And that is something that, again, is really attractive at a formation stage. And you just have to meet the substantial economic test with the IRS code, which basically says that if you receive an allocation of income or loss for tax purposes, that you also have a corresponding economic benefit. This is really attractive. Like I said, you can kind of slice and dice, in a sense, your equity. Preferred shares also create some flexibility in that sense, but obviously you don't have the flow through directly to your partners and members. With an S corporation, this is where an S corporation kind of falls behind in terms of a choice of entity. They don't have any flexibility, generally speaking. You have to get more creative. There's ways around it, but technically there's no flexibility in what you can get in terms of distributions and kind of slicing and dicing those distributions in different ways like you can with a partnership. And you cannot have any different classes of stock, which is also something you have to be careful of. Let's see here. Okay. Loss limitations. This is an important topic as well. Partnerships can, again, the members and partners can take losses that pass through to the partnership, to the partners. And there's some limitations. Basically, you can only take it up to the extent of your adjusted basis. There's at-risk limitations, which basically, hitting a very high level, is that you can't take loss in excess of what you put at risk in that business activity, that specific business activity. If you've got passive losses, they can only be offset against passive income. And starting 2020, there'll be a disallowance of excessive business loss. So if the deduction is in excess of your gross income and gains attributable to a trade or business, plus this threshold amount that I've set forth, then you're also limited with respect to your losses in that sense. So, and although there's limitations with a C corporation, you can't take the loss on it doesn't flow through to you as a partner or a member. The loss is only taken at the corporate level. So if you've got net operating losses, they can be carried forward or back. Starting 2020, you can only carry them forward, and they're capped at 80% or limited to 80% of the taxable income. So, that's another consideration. Basically, with a C corporation, if you're going to have losses in your initial years, you're going to have to take into consideration that you can't take advantage of that until several years of operation where you may have actual income. With S corporations, again, your losses are passed through. So that's another advantage of an S corp. Okay, let me just check the time here. So with sale of interest, partnerships, when they sell their interest, it's an exchange for income. I'm sorry, an exchange for a consideration, whether it's cash or property. And usually you have a gain or a loss. And it's if there's a gain, you have capital gains rates that apply. Um, unless you have hot assets, which are unrealized receivables, depreciation recapture, or substantially appreciated inventory, in which case you may recognize some ordinary income. And the purchaser basically takes a cost basis in the partnership interest. Um, the partnership's basis is unaffected by the sale of the interest. There is such a thing as a 754 election that you may have heard of, and that does make an adjustment to reflect the difference between the buying partner's interest and the buying partner's share of partnership interest in the actual partnership basis. Sale of stock is similar. C corporations generally recognize gain or loss on the sale of stock, and it's a capital gain. You may be able to get ordinary loss treatment if you have small business stock and it qualifies under 1244, which has some limitations on it. And you don't have to actually make an election, you just have to qualify. And the purchaser basically receives a cost basis in the stock. Again, the corporation's assets aren't affected by the sale unless there's some sort of a election made to treat it as an asset sale, which you generally wouldn't do on the selling side anyway. S corporations are the same as C corporations, and there's a loss on the sale of the stock, then you may qualify again for that ordinary loss, 1244 small business stock. And so I think the takeaway from the sale of the stock is there's not and in my mind, there's not a big difference. That's not one of the earth-shattering moments. If you have different kinds of entities, you're still going to get, for the most part, capital gains treatment for selling your interest, selling your shares, C corporations, S corporations, LLCs, and partnerships. And Brendan's going to talk more about this when he talks about the different kinds of transactions and M&A. But there's a difference when you are selling your assets. When a partnership sells its assets, there's the gains or losses are not taxed at the partnership level. They pass through directly to the partners, and the character of the gain or loss is determined at the partnership level. And the partners don't recognize gain on the distribution because they've already the basis in the partnership will have been increased by the shares. By their shares of the partnership gain passed through to them. But essentially, in English, that means, you're going to have a single level of tax. C corporations, different story. This is where I think founders really may have some buyer's remorse if they're looking to do an asset deal. C corporations, and a lot of times buyers will want to just purchase the assets. C corporation, you have a level of tax of 21% on the profits at the corporate level. And then again, when the profits are distributed to the shareholders, you have another tax imposed on the shareholders on the distribution. So that's where it really comes into play when you have a C corporation. S corporation is the same as a partnership. You have gains and losses that are recognized by an S corporation on the sale of its assets through its, and it passes through to its owners. It's not at the corporate level like a C corporation. Unless it was formerly a C corp, which we've talked about briefly previously. The shareholders don't recognize gain on the distribution of the sale proceeds unless it's in excess of their basis in an S corporation. And so before we move on to our next topic, again, if you have So what we know in just at a high level summary is if you've got a partnership, an LLC, an S corporation, a C or a C corporation, in terms of selling your interest or your stock, you kind of come out about the same, or there's not a kind of earth shattering tax ramifications if you had different entity types. But when you're selling your assets, it becomes a different story. You can really get hit big if you have a C corporation and you're selling your assets. So that's something to take into consideration. And it's really not something that can be changed down the line. C corporations aren't really flexible in that sense. If you try to change your entity type to an LLC or a partnership, you'll have a taxable event at that point. So, you're kind of married to a C corporation if you've been operating for a long time, and you may want to consider doing a stock sale rather than a asset sale. But again, Brendan hopefully will be talking about this in more detail because I do think it's an important aspect of our discussion. Another interesting difference between the entities comes into play when you're liquidating and distributing. So if a partnership makes a distribution of its assets to its partners, it doesn't recognize a gain. A partner could, if they receive a liquidating distribution that exceeds their basis in their interest in the partnership, they could recognize a gain. And the partner recognizes loss on a liquidation distribution only if the partner's interest is completely liquidated and the partner receives property or cash, and the and, and the basis is less than the partner's actual basis. So the distributee partner takes a substituted basis in the property when they receive it. Again, a takeaway from that is, partnership again is fairly friendly in a liquidation context. C corporation, you generally recognize gain or loss on the distribution of the assets in complete liquidation as if the corporation had sold its assets. So the shareholder recognizes gain, usually capital gain to the extent of the value of the assets received in complete liquidation, which exceed their stock basis. So that's not obviously a good result. If you have a controlled, as a side note, if you have a controlled subsidiary, that can be liquidated without a tax implication. If you're basically distributing out installment notes, they're received as part of a liquidation, the shareholder can report those in an installment method. So that's something that could be helpful. The shareholders recognize a capital loss if the value of the assets received are less than the shareholder's stock basis. Some or all of the loss can qualify as an ordinary loss if the stock is 1244, again, small business stock, which at a high level, basically, I think you have to have equity over $1 million. You can't have equity over $1 million, and it's domestic small business. And you can deduct basically up to 50,000 or 100,000. Shareholders' basis in any property received is the fair market value of the property, and the liquidation of controlled subsidiary into its parent. When that happens, basically when you're pushing up the assets into a parent, there's just a carryover basis in those assets. Because the corporation recognizes gain or loss on the distribution of its assets in liquidation, and the shareholders recognize gain or loss on the receipt of the liquidating distributions. Again, there's two levels of tax here. S corporations, generally same as C. You don't have the double tax, obviously, but upon the distributions of property, the corporate level gain on the deemed sale of the property passes through to the shareholders. So what I did want to point out again is that, with a partnership, if you're looking to liquidate out or just distribute out property, generally may not be a taxable event. With the C corporation, you will have a taxable event. And what's interesting is that with an S corporation, you could also have a taxable event if you're distributing out assets that are appreciated. And that's something I think sometimes that our uh, kind of flies under the radar, but that's why you don't have appreciated real estate in an S corporation generally, because you'll have that unfavorable tax ramification. Um, there are some tax-free reorganization solutions if you're trying to push an asset out without having a taxable event in a C corporation or an S corporation, but that can get fairly complex. So just to keep that in mind, a C corporation again and an S corporation doesn't really come out ahead on the liquidation front. Oh, let's see here. I'm running out of time. So now that I've really talked down C corporations, you're probably asking yourself why you would ever have a C corp. There's some employment matters, I think, that come into play. A C corporation, well, as a basic concept, C corporations can have W-2 income employees. LLCs and partnerships cannot. They can only, I'm sorry, they can have W-2 employees, but the members and partners cannot be W-2 employees. They can only receive a K-1. And that's something that sometimes goes under the radar. Your CPAs and your payroll companies sometimes will even put your members on W-2s, but they shouldn't be. In any event, there's a distinction there. In a C corporation, when you have W-2 employees, you can take advantage of fringe benefits, and that can really come into play as your corporation is growing. You know, cafeteria plans, life insurance plans. It's for just general fringe benefits that are tax-free to employees. That applies in a C corporation, but it's limited in the pass-through entities. So that's something to take into consideration as well. And I think we touched on unreasonable compensation earlier. For C corporations, you can't have unreasonable compensation if you're trying to basically pay your shareholders as employees in a way to avoid paying out dividends. And reasonable compensation concept also comes into play with S corporations, but kind of in the opposite direction. Something that's actually really helpful with an S corporation is that you don't have self-employment taxes, and basically the founders and shareholders can take advantage of those distributions tax-free until, well, not tax-free, but you don't have withholdings on your distributions, and you don't have self-employment tax on those distributions. And this is where the S corporation really comes out on top versus this the LLCs and limited partnerships. So what founders will do is try to push sometimes or shareholders will do, they'll try to push their income into distributions rather than wages, and they'll take small wages. In the Internal Revenue Service, we'll take a look at that and have some concerns about whether or not you have reasonably compensated yourself. So with C Corps, you have, shareholders trying to take a larger payment on their W-2, and with S corporation, a smaller payment. Okay, well, I am going to try to get through this fairly quickly here. The one thing I do want to point out with C corporations, I generally, if you're going to have a large pool of employees, you would want to consider having a C corporation as well, because these ISOs, NSOs, restricted stock concepts are familiar to both the employees, and the IRS has vetted them, and there's really clear, bright lines on these issues, and so it makes that a more attractive entity for those kinds of structures. Really quickly, restricted stock, basically you recognize income when you have when you receive restricted stock as a founder, and you make an 83B election, hopefully, and recognize the fair market value as ordinary income. ISOs, you don't recognize stock income and or you don't get taxed basically until you sell your shares, which is the best result that you would want for an employee, except for the AMT tax. NSOs, you recognize ordinary income on exercise, and that can be a problem sometimes if you have enough of those. Good problem to have, I guess, in some ways. And with LLCs and partnerships, you can have profits interest, phantom units, which are almost like a bonus payment. Profits interest basically gives you the profits from the time that you are granted the profits interest, and it's not taxable at the time that you receive it, at the time of grant, but until you receive it, basically. Same with phantom stock units. You're not taxed until you actually receive the bonus award, and all these things are basically baked into LLC operating agreements. Restricted stock units are a way an employer can get grant company shares to employees. And let's see here. Okay, so Brendan, I know I'm coming up on your time, and I promised you that I would finish on time. So I'll start to kind of wrap up here. So just quickly on the restricted stock, again, it's basically a grant of stock, but after vesting. So you receive the stock after you've actually vested. And with SARS, it's you receive a cash payment after you vested, and you recognize income at the time you receive it. With payroll taxes, I just wanted to touch on a couple things that gets clients into trouble sometimes. Again, with equity compensation, if you don't meet the safe harbor requirements, we kind of blew through that slide fairly quickly, but there's a lot of restrictions and requirements, and it's hyper technical. So if you don't meet those requirements, your employees could recognize income at a time when they're not expecting to recognize income, and then you have a withholding obligation. Or if you have independent contractors that either the state or the employees themselves see as being employees, basically, the service providers consider themselves as employees, then you can also have a withholding obligation there. And there's a responsible party. Okay, I think that I am done here. I apologize, Brendan. I ran over, and I promised you I wouldn't. So I'm going to hand it over to Brendan now.
No worries. Hey, Sep, can you stop sharing, and I'm going to go ahead and share my screen. Thanks. So I'm going to talk, guys, about 4 topics, and probably almost every one of them could be an hour-long topic unto themselves. We're probably going to go over a couple minutes, but what I wanted to do is touch on these very briefly. These are more, Sepi talked about the nuts and bolts of the different entities and the tax consequences of choosing the different types of entities, the benefits, the pros, the cons. I'm going to talk about some more operational issues that startups encounter as they're growing and things to think about. One of the questions that was asked, and Sepi, there's a couple of questions in the Q&A that you may want to check and respond to, was, with all the benefits of an LLC, why would you choose a C corporation, or why do VCs want a C corporation? There's many reasons. I'll touch on 2. One is usually they want you to have a Delaware C corporation because the state of Delaware has very business-friendly law. And that's a significant, if the business were to ever get sued, it's the law in Delaware is favorable to businesses. The second reason is this topic right here, which is qualified small business stock. So back in 1993, the QSBS regime, qualified small business stock, was introduced in the code at section 1202. And as I say in the slide, it remains one of the most powerful incentives for investors in startups. Generally speaking, if you satisfy the rules of QSBS, which I'll go into in a second, taxpayers can exclude from federal income tax or from capital gain on the sale of their C corporation stock. So there's an exclusion, and in some cases, these days, most cases, you won't recognize any gain if you sell QSBS. So what are those requirements? So there's 6 of them.
Hey, Brendan.
Yeah.
Oh, sorry to interrupt for a quick second. Do you mind hitting the presenter mode at the bottom, just so it's a little bit easier to see? Bottom right. Right next to the minus sign. It's on the, yep, right there. Mhm.
Okay.
Thank you.
Yeah, no problem. So let me back up. No, actually, we're in the right spot. So who can hold QSBS? It could be an individual, a trust, a state, and pass-through entities like LLCs and partnerships, but it cannot be a C corporation. Second requirement is you have to acquire the QSBS from the issuer, the corporation, in an original issuance. What does that mean? That means that the corporation has to issue the stock directly to you. You cannot acquire it from the secondary markets. There are exceptions to this, which will lead to some good planning opportunities. And the exceptions are receiving QSBS in a gift, a bequest because someone died, or in a tax-free reorganization. The other 4 requirements are you got to hold the QSBS for 5 years from the date of issuance in order to qualify for the exclusion of gain. The issuer must be a C corporation, and it has to be a C corporation for the entire time that you hold the QSBS. The issuer's gross assets at the time of issuance cannot exceed $50 million in value, and the issuer needs to be engaged in a trade or business. So the corporation has to be in a trade or business. So because of these 6 requirements and the potential to exclude all of your gain from the sale of stock, you need to be a C corporation, and that's why many investors require businesses to be formed as a C corporation. So how much can you exclude? Generally speaking, if you meet the 6 requirements, then you can exclude the greater of $10 million or 10 times your basis. In practice, we just go by the $10 million rule. You can exclude up to $10 million of gain from the sale of your QSBS. So when the statute was written back in 1993, they basically said you could exclude 50% of the gain, up to $10 million. So if your stock was sold for $10 million back in 1998, you could exclude $5 million from tax. There was a weird period of time due to tax law changes in 2009 and 2010, where the exclusion was increased to 75%. And after 2010, we now have 100% exclusion. So what does that mean? It means that if you sell your stock for $10 million, meet all the requirements, you can exclude from gain 100% of that $10 million. You can basically take it tax-free. There are planning opportunities that you need to be aware of. So a taxpayer can own QSBS individually or through certain pass-through entities like an LLC or partnership or S corporation. Here's the rub though. If you have QSBS and you want to transfer it to the entity, you may hold it for a year before transferring it to an LLC. And when you transfer it to an LLC, the 5-year holding period restarts. And so you would have to hold the QSBS in an LLC for another 5 years before you could sell it and exclude 100% of the gain. Recall when I was going through the requirements, I said that it had to be issued by a C corporation, but I said that there were certain exceptions. This gives rise to estate planning opportunities. If you transfer QSBS, say you have shares that are QSBS, and you decide to keep half of them yourself, and you transfer half of them to the trust for the benefit of your child or another family member, you do what we call stacking, which is you're stacking multiple $10 million amounts to maximize the amount excluded. So if you held 50% of the QSBS stock and you transferred 50% of it to a trust for the benefit of your child, and you sold the stock for $25 million, you would qualify for a $10 million exclusion. The trust for the benefit of your child would qualify for a $10 million exclusion, and you'd only pay tax on the extra $5 million. You'd basically be able to shelter $20 million from tax. We also need to be aware of QSBS rollovers, and that's governed by Section 1045. And what it does, what this section says is it allows taxpayers to defer capital gain on the sale of QSBS if they roll over the sales proceeds into replacement QSBS within 60 days of sale. In essence, you are deferring tax on your original QSBS into new QSBS stock. And you may ask yourself, well, why do we do that? Well, it's because you probably haven't held the stock for 5 years. So the 1045 rollover says that you only have to own the stock for more than 6 months prior to the sale. But when you do sell it, you have to reinvest it in new QSBS stock within 60 days of the sale. The other requirement is the new replacement QSBS needs to be a trader business, and then you need to make an election to defer on your tax return. Let's go back for a second to my my $25 million sale example. Again, transferred stock to a trust for the benefit of your child. You held stock yourself. You excluded $10 million. The trust excluded $10 million. You had $5 million left over. You actually could not pay tax on that if you reinvest that QSBS stock into new QSBS stock via the rollover here. So in theory, if you sold stock for, if you had taken advantage of the planning opportunities early on and sold stock for $25 million, you would be able to exclude or defer tax on all $25 million. So we're going to pivot now to international operations and international employees. Again, this could be a topic that's an hour on its own. I'm just going to talk about two things that I think you should be aware of. We joke here in Silicon Valley with accountants and lawyers that we work with that sometimes our startup clients have an international footprint before they have a US footprint. What I wanted to discuss is that, you know, expanding into foreign jurisdictions is great, and it may be a lot of opportunity there, but it can create tax issues for the business. Traditionally, a business had tax nexus in a foreign jurisdiction if it had permanent establishment. In other words, its activities rose to a certain level, and usually that was some sort of physical presence. You had your offices there, you had some manufacturing, and then once PE was established, the business was subject to foreign income tax laws. As the economy has become more of a digital economy, you don't have to have physical presence in a particular foreign jurisdiction because it's a digital. You know, you may be in the cloud, you may be online, you may be the internet, and you don't have to have office space or physical location in France or Germany or the UK. And so foreign countries have been losing or have had their tax base decreased, and they're trying to expand the definition of permanent establishment in order to tax digital companies. There's two proposals that are out there right now. One is if you have an in-country sales agent, we call them a dependent agent, sort of working on behalf of your business. Countries are trying to say that that would qualify as having permanent establishment for your business. The other thing that is being proposed right now is taxing the value that is created within the borders of the country. So if there's a digital download of your company's product, the argument is that you now have presence locally in that country. There's a digital presence, and therefore that should qualify for permanent establishment, allowing that country to tax your transaction. Want to talk about foreign personnel. there's always the old adage between, do I want to hire an employee or do I want to pay an independent contractor? Independent contractors are cheaper for the company, but we really urge you to engage local counsel to ensure that in that country, what you think is an independent contractor is in fact an employee. And if you get this wrong, then you may be faced with back payroll taxes in that country that you never thought you would have to pay. I'm going to skip over managing payroll and just remind you that if you do have foreign personnel, you probably want to incent them with stock options or some of the equity, synthetic equity that Sepi had talked about. What you're going to need to do is you're going to need, and you can pay them stock options from US stock options from your US based company, but you're going to want to amend your stock option plan to provide for foreign participants. And then you're going to want to tweak your award agreement to basically insulate yourself and your company that you're complying with all of the US tax laws for withholding and so forth and reporting. I think the foreign operation pitfalls that I just want to say at a high level is, please try and engage US and foreign tax experts before you expand internationally. Make sure that you know that your independent contractor is truly an independent contractor in that country. Make sure you pay all your taxes and plan carefully. Sales tax is another pitfall for a startup. And fundamentally, sales tax issues can cause a financial burden on a startup because they all of a sudden receive an audit letter from a state saying, hey, you owe X dollars in sales tax. There can be multiple sales tax jurisdictions. It can include states, cities, counties, foreign countries, foreign cities, foreign provinces, and they all may have different laws. You see, when you buy something locally, you have a California sales tax and then a county sales tax. And you may have on top of that a city sales tax. And as a seller of product or services, you're responsible for knowing all of those laws. The concept of sales tax is that if you sell goods and services, you as the seller are responsible for collecting sales tax on the transaction and then remitting it to the taxing jurisdiction. And if you're not collecting it, if you're subject to sales tax in that state, city, township, or what have you, and you don't collect that from your clients or the end users, you're going to be left holding the ball, and you're going to be responsible for paying that bill in a sales tax audit. Sales tax nexus is pretty similar to what I talked about for international nexus. Sales tax nexus is a little more fluid. They have the physical presence concept. But you can also have sales tax nexus by having employees there, having employees travel to a particular state for meetings or conferences, or even employing third-party contractors in a state. So it's a little broader. I guess the one way of saying it is you can have sales tax nexus in a particular state without having much contact with that state, which makes it more dangerous. I'm not going to spend a ton of time on this slide. I think we're going to post these on our website or can make them available to you if you want. Fundamentally, the Supreme Court in a couple of significant cases upheld the concept that physical presence creates sales tax nexus. States have been working over the last 20 years to expand the definition of what physical presence means. Again, like international taxes, they're reacting to the change in the economy from a brick and mortar economy to a digital economy. So you see here that some states considered click-through nexus, which is if your website is hosted in state A and you have to click through to a different website in another state to buy the product, that click-through nexus to the other website would be enough to create nexus in that other state. And then Massachusetts a few years ago came up with the concept of cookie nexus, which is a combination of how much did you sell in that state, how many transactions were there, and did you place a tracking cookie on the customer's computers? The cookie part's kind of tough to track, I think, which leads us to kind of the last significant event with Sales Tax Nexus, and that was in 2018, so just a couple years ago in Wayfair. So basically what South Dakota realized is it was losing out on tens of millions of dollars of sales tax revenue each year. They crafted, the state legislature crafted some language that provided for the concept of economic nexus. And fundamentally, it said that if you sold greater than $100,000 in sales or more than 200 individual transactions in 1 year in the state of South Dakota, you had economic nexus and you had the responsibility for collecting sales tax. Supreme Court said, yep, we agree. And so since 2018, we have this economic nexus that states are rewriting their sales tax laws to create this economic nexus. I think the takeaway that I'd like to share with you guys is that if you're doing business online, you really need to be able to track where your end users are and understand what your collection and remittance obligations are. And it's really good to stay in contact with a tax lawyer or a tax accountant who can help you figure out the laws that may be applicable to your business, because you don't want to receive, in 3 years from now, an audit letter saying that your business owes $1 million in sales tax revenue. Last topic here is understanding the types of acquisition structures in kind of an M&A deal. So the thought here with this slide, or these series of slides, is to get you thinking about your business. And if you felt like you were going to be acquired at some point in the future, you have a basic understanding of how those acquisitions are structured. We will be having a seminar on this through the SV Forum on October 28th, and it's going to be on valuations and M&A transactions. So we'll be taking a deeper dive next month, but I wanted to just sort of place have you thinking about this so that you may understand the types of acquisitions. It's either, and Sepi touched on this earlier, so I can kind of wrap up with this. You have either a taxable acquisition or a tax-free acquisition. A taxable acquisition is when buyer buys your assets, your IP, directly from the entity, or buyer buys your stock. And if your stock is QSBS, sort of connecting the dots, you may not care that it may not be taxable to you. The sale of your stock, the gain from the sale of your stock may be fully excludable. Again, another reason to form a C corporation. On the tax-free acquisitions, you have mergers and reorganizations, which are kind of tax sleight of hands. And I'll get into those here briefly. Just, in a taxable stock acquisition, your tax on the sale of your stock at capital gains rates could be 20%, also could be fully excluded under QSBS. Taxable asset acquisitions, this is where buyers always going to want to buy the assets because they get a step up in basis in the assets that they can then depreciate over time. If they're buying your stock, they're buying the company and the liabilities, and they do not get a basis step up in the underlying assets. So if you have a taxable asset acquisition and you own a C corporation, selling the assets would yield tax at the C corporation level. And then when the corporation distributes the money out to you as the shareholder, you're going to get taxed a second time. So that's one of the downsides of the C corporation. You can see probably one of the themes is there are benefits to having a C corporation and there are detriments to having a C corporation. There are benefits to having an LLC and there are detriments to having an LLC. And that's sort of why you get lawyers and accountants involved to walk you through things. We're wrapping up the slides here. These are the tax-free acquisitions. There's a straight merger. where you can, your company is merged into buyer. You get stock and buyer, and you can get up to 60% of the consideration could be cash, which would not be taxable. There's a B reorganization where seller, you give up your stock in exchange for buyer stock, and your company becomes a subsidiary of buyer. The downside of that is you can't receive any cash. So you're giving up your company in exchange for seller's, buyer's stock. And so there's no real liquidity event there. A C reorganization is a sale of assets, and you would get back buyer stock, and up to 20% of the consideration could be cash. And then D and E reorganizations are similar to the A merger, in which case you're merging into, buyer creates a subsidiary, you merge your company into the newly created subsidiary, and your company survives, or newly formed subsidiary merges into your company and your company dies. Like an A reorganization, in these subsidiary mergers, you can have up to 60% of the purchase price be cash consideration. Last slide for me, and then we'll take any questions. A lot of times in deals, we see a company not getting as much money as it normally should get. Its valuation is depressed. Now, you would work with investment bankers to deal with your financial metrics to make sure that you're healthy from a financial standpoint. But if your company is a legal mess, you can also depress the value of it because you haven't taken care of your business. You haven't cleaned things up. That's actually something our firm does really well, working with businesses to try and close up all of the legal loopholes in order to ensure that the valuation of your business is high. So you want to make sure your business is fit. You want to make sure all your formation documents are properly taken care of and that you can access them. You want to make sure that if your business has IP, that you actually transfer the IP to your business so the business actually owns it instead of a founder or a founder's buddy that's no longer involved with the company. Avoid any litigation at all possible. Make sure your tax returns are filed. Ensure that your employees are properly classified. As you can tell, this is kind of a big thing, particularly in California and internationally. You want to make sure you have no outstanding liabilities that a potential buyer would say, yeah, I don't want to take that risk, or I'm going to lower the purchase price because we're not sure whether we're going to get hit down the road. And then engaging in any pre-transaction tax planning. Sometimes you only want to sell off one line of business. We can go ahead and sort of move things around into different entities such that you're just selling off that line of business and you're continuing to operate a different line of business through your entity. So I know that was all a little quick. We are available for questions, not just now or today, but also at any point in the future. Again, we are going to be having a valuation and M&A segment next month, October 28th. And with that, I'm going to wrap it up.
Thank you so much. Did you see a couple questions that were hanging out in the Q&A box? I don't know if you had a minute to get to either of those.
So I see the first question: can QSBS be captured in a venture capital LLC as an LP? I'm not sure what captured means there. Can QSBS be transferred to an LLC or an LP? Yes. Can you form an LLC or an LP and qualify as QSBS? No. And then can a Roth IRA own QSBS? I don't think so, but I can't say that definitively. I'd have to double check.
All right, excellent. Thank you so much, Brendan. Did you want to go ahead and drop your email address, either of you, into the chat box in case anybody has any follow-up questions to today's event, or if they just want to get in touch with you?
Yeah, so it's on the screen here, but we can also put it in the chat.
Oh, perfect. Thank you. So great. Thank you so much for the presentation, Brenda and Sepi. That was so much great information for everyone. And as a reminder, as Brendan mentioned a couple times, we will be talking about mergers and acquisitions on our October 28th program. But our next one in the series is actually on September 23rd, and we are going to be taking you to school on term sheets. So what do you do when you get one, right? So thank you for joining us today, and hope everybody has a wonderful rest of your week. So thanks. Bye.